right. Hi, everybody. Today we're going to talk about Celsius and Celsius stock specifically. To me, it seems like everyone is talking about that stock right now. That's at least what it looks like when I browse my Twitter feed, my feed on X. And today we have a guest. Again, it's Andrew, because Andrew knows the beverage industry quite well. What I find interesting about Celsius stock is that the stock is down close to 70% over just a 4-month period. And obviously that's quite a staggering drawdown considering that it's such a short time period. Nonetheless, if you take a look at the last 5 years of performance of that stock, the stock is still up 2,800%, which makes it even more mind-blowing, I think, that despite this big drawdown, the stock is doing so well over a 5-year time period. And there's a reason for this. If we just look at the development of revenue at Celsius, just back in 2016, the company only generated revenues of around 22 million US dollars. Fast forward to today, and the company is able to bring in almost 1.5 billion in revenue just 5 years later. And even back in 2020, the company only generated 130 million in revenue. So you can certainly see where the great stock performance has been coming from. And we are going to discuss whether we are looking at an attractive opportunity considering the drawdown of Celsius stock. And in our investing community, this is also actually the quality stock of the month that we are researching as a community, sharing our thoughts on, sharing resources we come across. And Henry, I'm just going to hand it over to you here to maybe briefly share your initial take on the stock.
Yeah, well, I guess I can share more kind of I suppose the bullish thesis or the way I view it. And full disclaimer, I do own a position in Celsius, but it's my largest. I mean, it's my smallest position in my portfolio. It's really just a tracker position, and the main reason why isn't questions necessarily I have surrounding the company. It's really just a valuation thing. And we'll get into that later in this video. But basic elevator pitch would be that it's a fast-growing brand in an addictive and growing industry where really the end consumer behavior is easy to assess. I mean, if we just do rough math, right? So I think the average adult consumes about 5 cups of liquid a day, and then I think I saw in research something like 80% of all adults consume a caffeinated beverage at least once a day.
That's in the US?
That's in the US. And then if you assume that, maybe 20% of those or 25% of that consume more than one caffeinated beverage a day, you can essentially say, that math equals out to 100% of adults consume at least one caffeinated beverage every single day. And so if they're consuming 5 cups a day, at least one caffeinated beverage a day, that's going to be, 20% of all liquids consumed by adults is essentially caffeinated beverages. And then the only trend that doesn't really change over time. What does change is the way it's consumed. So whether that's being consumed through coffee or energy drinks or tea or soda, powder, Coca-Cola powder. Yeah, exactly. So you just have to, that's really the trends that you have to worry about. But I mean, the fact that 20% of all liquid consumed is probably caffeinated isn't really going to change.
And the energy drink industry or sector itself has been growing for quite a long period of time, right?
Pretty healthily for the past 20 years or so, probably a little bit before then, but I think it's been the fastest growing beverage category for at least a decade now. And that actually just switched. Once again, we'll get into, the fact that maybe the industry is slowing down or whatever, but that switched to coconut water, at least in the United States. Coconut water is the fastest growing beverage industry now. Or beverage category in the industry. But yeah, so back to Celsius. So it's easy to assess. And Celsius has really positioned themselves with substantial mind share as the premium player. And they also have a healthy cost structure, which should largely be enhanced through the Pepsi partnership. Now to give you some numbers, right? I went back and did some numbers on how really this partnership will help leverage the cost structure throughout Celsius. So really, the main example would be that through this deal, Pepsi is also helping take up some of the expense of sales and marketing. So what we can see is, right, so Monster runs roughly a 50% gross margin. And then 50% of that gross profit is marketing and sales. Okay, so in simple terms, 25% of their revenue goes back into sales and marketing. That's Monster Beverage. Okay, that's pretty consistent. Now, for Celsius, until 2022, which September 2022 was when the deal with Pepsi went through, up until that point, SG&A used to be 50% of Celsius's revenue, not 50% of their gross profit, 50% of their total revenue. Since 2022, this number has dropped down to more in line with, my scribbling is a little
I looked at it
confusing, but it's more in line with Monster now. So you're seeing what you're seeing is their revenue increase, but their SG&A expenses are pretty much flat over a 2 to 3 year period, and that would explain that the Pepsi deal, right? The Pepsi taking over some of that SG&A expense for them. So you're going to be seeing a lot.
I'll be out with the numbers here real quick. So if we look at the Q4 numbers of the 2023 fiscal year, over the last 12 months, back then, Celsius generated 1.3 billion in revenue, and SG&A was 350 million.
Yeah, so closer to like about 25%.
Less than a third, right?
Yeah. So call that 25% roughly. That's right in line with Monster. Now, can we go back to pre-2022? Let's go pre-COVID to be safe here, but really pre-2022. So if we go 2019.
So that would be Q4 2019, 65 million in revenue, and SG&A back then was 26 million.
Yeah, so you're seeing
gross profit was 39 million. Yeah, so
yeah, exactly. And then scroll to 2021 and 20, or go just to 2022 here. Just wanted to see something. So you're seeing, just go to the so SG&A is what, 424 million.
Yeah.
And then can we go to 2024? I guess we'd have to do it on a quarter of, yeah.
Yeah, so
and then SG&A hasn't increased, but yet their revenues have doubled. Yep. You know, so the point being that I'm sure the SG&A for the brand has probably moved in lock and step with the revenues, but you're seeing Pepsi take over a lot of that SG&A expense.
Yeah. So let me take you back one step here again, because I took some notes before we hit the record button as well. So my understanding is, and maybe you can walk me through your thinking regarding this as a consumer yourself. I think you do consume Celsius, do you? Every once in a while?
Once in a while, yeah. I've switched.
So you're not a loyal customer.
If I'm going to have a pure energy drink, it would be Celsius. Yeah. But there's this other brand called Yerba, which doesn't use sucralose, it uses stevia.
Yeah, but the point I want to make is that you, as someone living in the US, you probably have a better sense for what the consumer sees in Celsius as opposed to some of the other brands. And I think one of the more bullish points when it comes to this brand is that it's counterposition to the more established companies here, being Monster and Red Bull. And so my understanding is that it's much more health focused, also aiming an audience that is almost equally made up of men and women.
Probably larger women. That's at least where they carved out their niche, and they're probably expanding now.
Yeah, and their whole branding and also the packaging is definitely very different to what a Monster can of energy drink would, for example, look like, right? So how do you see the brand as being counterpositioned to the more established brands in that industry? Is that a sustainable edge for the company?
I mean, I would argue it probably is, and I know in the short term there's a lot of short term noise, but the real way that they position themselves with it was supposed to be a healthier alternative, sugar-free alternative to Monster and Red Bull. I mean, if you can believe it, the Monster and Red Bull went the longest time without really, a real focus on the sugar free. And if they did have a sugar free option, they weren't really promoting it or weren't really marketing behind it. And that was really an opportunity. And back in the day, there was also Rockstar. So, I mean, Celsius really took advantage of that opportunity in the market. And it took them a while to gain traction, but when they did, they found that core customer, and then they really pushed behind that SG&A. And if you actually look at their SG&A numbers from when the brand really started to take off, even though they weren't really calculating an ROI because they weren't technically profitable, if you look at their SG&A expense and then the incremental growth to that revenue, they were actually earning like a 50 to 100% ROI on the SG&A expense, if we're considering ROI to be revenue growth. So I mean, they found a niche and they really marketed behind it pretty well.
Yeah. And that niche should also, I guess that's part of your thesis, allow them to continue to grab market share from the more established companies here, right?
I believe so. I don't believe that anyone's just going to wake up in the morning and go say, "Oh yeah, let's go back to sugary drinks." I mean, if that were the case, Coca-Cola would have found a better niche than they have over the past 20 years. So,
yeah. So, Andrew, help us understand why the stock is down 70%-ish over just a 4-month period. I think that is incredibly important to understand. And I think this goes back to understanding the critical role that distribution plays in the beverage industry. Can you just give us your high-level thoughts on why having a partner here is so critical?
Yeah. So, well, first to address the point of why is the stock down, I mean, other than the obvious answer of there's more sellers than buyers, it's first off, if you look at like the valuation for the past really since 2018 or so, I mean, it was just disgustingly overvalued. Never mind over 10 times sales, but this thing was pushing 20, 30 times sales. So
I think it was trading at some point close to 40 times sales, actually.
Yeah, so that's a bit insane, right? So at some point, all good things have to end, right? So had to come back down to earth. I mean, even arguably today, and we'll talk about this, like I said, later in valuation. It's not the most obvious, like shooting fish in a barrel opportunity. I mean, it's pretty fairly priced, I'd argue, right now. But going back to the perceived slowdown of the brand, that's really the main headlines you're going to see. You're going to see the massive revenue decrease. So if you're going to be investing in the beverage industry, specifically, this probably applies to other industries as well. I have my brain ticks for the beverage industry. I've always been into beverages, right? So for the beverage industry specifically, it is required. It is not an option. It is required that if you're going to sell into stores, into multi-outlet channels, that you need a distributor. Okay, so the distributor is really the license to print money. But if you're going to start your own beverage company, you need to go through a distributor if you want to sell into Walmart or whatever. The only time this doesn't apply is something like a wholesaler or selling on e-commerce. So if you're going to sell through Amazon or Costco, those count as the distributor. But if you're selling anywhere else, you need a third party involved. Okay, so the third party forever for Celsius was a bunch of different distributors because they all had their own little shelf space, their own little niche, their own little stores that they could sell to. And then they did this deal with Pepsi, almost a pure exclusivity deal with Pepsi. It's not 100%, but it's pretty much the bulk of their distribution now is through Pepsi. Okay, which means that Pepsi buys that merchandise off of Celsius and then they sell it themselves. Celsius registers on the books revenue when Pepsi takes control of that inventory. This has nothing to do. So whether Pepsi sells all of that inventory or none of that inventory, Celsius books that as revenue. Pepsi then has to go put it on the shelves and then sell it through to the consumer. Okay, so in the beverage industry, there's revenue, but then there's arguably what's more important and what you really want to focus on, which is it's called different things, but sometimes it's called depletions. So really you want to focus on the depletions, or you can also focus on the scanner data, right? So the scanner data is actually what's scanning in the stores. So the scanner data
just to interrupt you real quick.
Yeah, please interrupt.
Readily available?
No, unfortunately, no, because it's data that's readily available, but you'd have to pay a hefty price tag for it. So obviously all these big company, if you're a major beverage player, you're going to pay for this data because you need to know how you're fending. You need to know what's working against competitors and what's not working, right? And then obviously analysts will have access to this data as well. But yeah, so if you can get your hands on the scanner data, that's really what you need to track. Now, certain beverage companies will report this data better than others. If they want you to know the numbers, they'll report it. If they don't want you to know the numbers, they won't. So in our case, what happened, right? So it's kind of to stay on topic, and Renee, please interrupt me if I'm ever going off topic. But Pepsi, because they had this pure distribution deal with them, they said, hey, this is a land grab right now. We want to make sure that we have plenty of weeks on hand of inventory. So they ordered a bunch from Celsius. And that's why you saw their revenue increase 100, 150%, whatever it was. Now,
and by the way, that's what you as a Celsius shareholder would also want to see, because you want to have a partner who wants to seize the opportunity if he sees one, and doesn't want to act like cautiously, play it safe, right? Because at the end of the day, Pepsi is also taking on the risk, right, by so aggressively loading up on Celsius inventory.
Yeah, if they can't sell the inventory, they're going to have to write it down. Just like Celsius, if no one was buying the inventory off of Pepsi, if Pepsi wasn't buying the inventory off Celsius, they'd have to write it down. So yeah, and then also Pepsi took an equity stake in Celsius as well. So they're obviously taking a somewhat of a risk in that sense. Not really too much of a risk for Pepsi based on
I'm not sure if we mentioned it, but this was back in 2022, I think. And as of
September 2022,
yeah, Pepsi owns an 8.5% stake in Celsius, which sort of helps us incentivize them to act in the best long-term interest of Celsius as well, right?
Mm-hmm. Yeah. So that's essentially what you saw happen. And Pepsi and people, investors, clearly it was evident in the price to sales that people were assuming that this 100% growth was going to continue forever. It was pretty obvious that it wasn't, especially if you were looking at the scanner data. The scanner data was I think if you go back to that time, it was showing about 40% growth. So still extremely, extremely high growth. But the 40% growth did not justify the 100%, 150% revenue growth for Celsius. So that was kind of obvious that Pepsi probably overstocked. However, maybe it was justified because they could have gone into new markets or whatever. So now what you're seeing is they essentially come out and are saying, look, we're not going to be Pepsi's doing these restocking. And they're saying, look, we have to work through this inventory. We're not buying more of Celsius right now. We're decreasing our order by 100 million this year, whatever it may be. And so people are saying, oh my God, instead of growing 100%, Celsius is only growing, I think, 23% revenue growth expected this year. So that 23% is important because if you look at the scanner data shows that Celsius is growing 36%. So once again, maybe dropping down from 45, 50% growth to only 36%. That's still extremely healthy growth. That shows that the demand from the consumer is there. That's really what you want to focus on, the demand from the consumer, not the demand necessarily from, the distributors such as Pepsi or whatever. Now, over time, when the growth stabilizes, those two numbers, the sales, the revenue growth
should converge, right?
And exactly, and the sell-through data should converge, right? But
so what I was thinking when you were describing this just now is that this is actually what a long-term shareholder likes to see, right? So there is, at least on the surface level, sort of a short-term blip the company is going through. Revenue, apparently, as you explained, that's just on the surface level, comes down, which leads to a re-rating of the stock. And if that re-rating is too aggressive, we'll get to that a little later, you might find yourself with an opportunity because the end consumer demand is still there, still growing healthily, as you pointed out. but your average investor may not be able to figure this out, or is playing a shorter, is more focused on a shorter time period. And if you are looking at that stock with a 5 to 10 year time horizon, you might find an opportunity for yourself, right?
Correct. Yep.
Perfect. Someone asked this question here on Twitter, and kind of asked me to ask you about it, because you're the expert in that industry. I don't know a whole lot about it. Just recently started looking at Celsius, and I'm going to learn a lot from you here myself. So I'm not sure to what extent we answered this question already, or you did. So the question is, how does Celsius partnership with Pepsi influence its market strategy, and how might this differ from competitors? I guess that's an interesting angle in the energy drink space, such as Monster or Red Bull. Does it influence how they go to market?
It shouldn't really. The only thing that would change, so like Pepsi, once again, Pepsi being the distributor here, has, you know, access to pretty much the premium shelf space that you want. So the eye level shelf space, right? The end caps, the specific displays that you'll see in stores, right? The coolers, they'll have their own coolers set up. That's extremely valuable real estate to the store, obviously. And Pepsi obviously pays a premium price for that real estate. So if you can get Pepsi to promote that for you, you know, they have your own Celsius cooler, have it in its own standalone section, not necessarily blending in with all the other energy drinks. That's extremely important. So that would help, right? So that's obviously going to help. But I don't think it necessarily changes the strategy. Perhaps international, it might change the strategy a bit. So I know based on the terms of the deal, if you read that proxy statement, was that going international now, part of the deal was that Pepsi has, I forget the exact phrasing of it, but was essentially Celsius has to first allow Pepsi to take that distribution. And then if Pepsi does not want that distribution, then they can bid it out elsewhere. They can go searching for other distributors. So so maybe it changes the way that they go international. Like right now, I know international, they're using Suntory as most of their external distributors throughout the rest of the world. Does that change over to Pepsi? I don't know. Sometimes it might make sense for Pepsi. Other times it might make sense just to use a different company, a different distributor, such as Suntory. So that's really, I guess, the only thing that would change. But by and large, it shouldn't really change the way that they're trying to go to market or anything.
And it's not like the company did some kind of rebranding, like aggressive rebranding, like they did in the past. So that kind of supports what you were just saying.
I mean, the only people that know Celsius is even backed by Pepsi now are investors. I mean, no consumer would ever know that Pepsi was an investor in Celsius, just like no consumer knows that Coca-Cola is an investor in Monster, right? Like no one knows that unless you're an investor. So
yeah, I'm just going to add some data points here to sort of back the thesis that you put out there, that the end consumer demand is actually quite healthy. So if we just look at the market share in the energy drink space in the US, I think Celsius, as of the most recent quarter, has a market share of around 11.5%, which is up from 8.7% just a year ago. And again, just for context, Monster and Red Bull, they have been losing market share. And as of today, apparently have a combined market share of around 70%. What I was then reading, and I'm just going to quote one Celsius executive in just a second, is that on Amazon, Celsius actually has a market share of 20%, which I think is interesting to assess the strength of the brand. Because obviously on Amazon, there's no shelf space, right? Obviously, there is to some extent, maybe you pay to be listed at the top. But I think for the most part, consumers are probably actively searching for a particular energy drink to then order it online. Do you agree with me so far?
No, I do agree. Yes.
Yeah. And so just to get to the quote, so he said, Celsius popularity is evident by the fact that they are selling better online, where you're not up against what's available in the stores, but what people want more when it's equally available. So that sort of, I think, supports your claim that the end consumer demand is still growing quite healthily.
Can you go scroll up for a sec too?
Yep.
Just scroll up right here. That's also something
here?
I want. Yep, right there. That's also something I want to point out. So you see the year-over-year change, and you see now that it says Pepsi is 60% of Celsius's business right now. Once again, that's important. It's 60% of their revenue, which obviously, like I said, is really gonna jostle them around quite a bit because they're very dependent on one distributor now. But 60% of their revenue, my hunch, and I don't know this for a fact, but my hunch is that it's not 60% of their sell-through. Once again, I think their sell-through or their scanner data or their depletions, right? All of that, I think, is probably a bit more diversified than what we're seeing with this revenue breakdown in that chart.
So you expect that number to come down because Pepsi essentially overstocked?
I do, yeah. I mean, it'll probably drop to maybe 50% or something. And might grow back up to 60% over time, once they start getting a chokehold on these other distributors and getting the pure distribution for Celsius. But right now, as it stands, no, I don't think 60% of their business is actually accurate.
Perfect. All right, before we move on, Andrea, I just wanted to ask the audience what they think of Celsius stock. I'm going to question you about the quality of that business in just a second. But before we start discussing it, maybe the viewers on YouTube want to comment below whether they think we are looking at a quality business here that is also trading at an attractive price. So quality stock, we too like to invest in quality stocks. Why do you think we are looking at a quality stock here? Why did Celsius make its way into your portfolio? And just to make things a little easier for you here, to go back to the conference that I was quoting from earlier, there was one line that really stood out to me. And here the executive said, energy is the jewel of the beverage industry. And I found that quite interesting. Why is that?
Why he said that, I'm not sure. But if I had to answer for, I mean, it's probably because it's like I said, other than coconut water, so technically now, it's the fastest growing.
Maybe a bit differently, Andrea. I know that you also own a stake in the Boston Beer Company. Would you say the energy drink space is more attractive than, say, the beer industry?
Beer overall, as the way that 99% of people think about beer, absolutely, yes. If we think of beer as a fourth, because beer is in decline, so are spirits, so is wine. If we think of a fourth category of alcohol, so if you were just to say energy drinks or alcohol overall, my answer would be no. I'd prefer alcohol, even though technically energy is growing faster. I think, for example, consumer behaviors change, as we talked about. So if we were saying caffeine versus alcohol, that would be tough. Why would that be tough? Because the way that people, or I should say, going back to that liquids, how much liquids people consume on a daily basis, et cetera, that doesn't really change caffeine. People who are going to consume caffeine are going to consume caffeine. People who consume alcohol are going to consume alcohol. And pretty much both of those categories, the amount that people are consuming, you're probably seeing flat to maybe slight, I mean like 0.01% decline of people year over year, but you're also seeing an increase in capita. So per capita consumption maybe going down slightly. However, the capita, meaning the people on Earth, are growing. So you have very, very stable industries. The one thing that's tough to pinpoint, and this is kind of where my investing strategy comes in. It's like I said, it's more of like the Peter Lynch, the scuttlebutt method. I really like to go in stores, talk to distributors, talk to friends at parties, see, or just, simply look and see what people are consuming, right? That way you can stay ahead of the trends, but trends change. So if we go back to our parents' generation, I mean, coffee, like people consumed coffee like it was nothing, or actually maybe Coca-Cola, probably sodas in my parents' generation. And then my grandparents' generation was really the coffee. That was the big growth category, was coffee, right? So what will that growth category of caffeine be in another 20 years? I'm not sure. I doubt it will be energy drinks, but who knows, right? same thing. So for alcohol, once again, beer, no, I'm not very bullish on that. However, if we think of this beyond beer, or this fourth category of beer or alcohol, really canned cocktails and hard seltzers, or flavored malt beverages such as hard tea, right? These are growing categories, so it's a little bit more nuanced than that. So energy drinks is growing faster, but the alcoholic beverage space is probably a little bit more stable. So I think it's a trade-off.
Here's what I was thinking. Let's just say structural changes aside, if we think about the price point on a unit basis, I thought, well, for whatever reason, some energy brands are able to charge a significant premium to the production cost when it comes to one energy drink can, right? And what does a Celsius can cost? Like $2.50 maybe?
Well, depends. It's about $2. Yeah.
Yeah.
And
how much would be a bottle of beer in the US?
Well,
less, right?
Because you buy it in packs, right? I mean, I guess unless you get a tall boy. If you get a tall boy, you're probably paying maybe $5 or whatever. But you're buying them in cases, right? You're buying them in 6-packs, 12-packs, 24-packs. So, but yeah, I mean, and it also depends. So that's another thing that's interesting when you're going to be invested. This is why I like beverages, because the comps for their competition is all pretty much stable, right? So it's not like food. I don't really like food for multiple reasons, but food, the price points vary so much. Beverages, I mean, your price point really isn't going to change all that much. I mean, unless it's like this really, really niche drink. Other than that, if you're going to buy an individual beverage, you're expecting to spend anywhere from $1 to maybe $3, right? You're pretty much in that range. And then you can look at the competitors based on what's in the shelf and see who's selling at the premium price point, who's selling at the lower end. So that's pretty stable and is pretty simple to assess. And the same thing goes for alcohol. So once again, there's premium alcohol, there's the low end alcohol like Bud Light, where they're just worried about volume, whereas the premium side is more concerned about the margins. So yeah, I kind of lost my train of thought there, but
yeah. Let me help you out here. So the point I wanted to address is ultimately, if we speak about or discuss whether Celsius is a quality company, we have to assess the pricing power of that company, right? And my understanding, and I'm not an energy drink consumer, and I also drink very little alcohol, but if I would go to the supermarket here next door, I'm pretty sure a Red Bull can would cost me around €3. On the other hand, a bottle of beer might only be 80 cents, maybe €1. So I'm not sure if the prices are different in the US, but that tells me that for whatever reason, and marketing plays a big role in that, obviously, some energy drink brands are able to charge a significant premium to their production cost on a unit basis, right? Which is why I think this brings me back to the quote here. Energy is the jewel of beverage. I think this is what he had in mind, but I might be wrong. That's just my hunch.
It could be, but it's probably the fact that it has a tailwind too. But don't forget too, I think the key thing is that energy is because it's what gives you the energy. It's caffeine. What is caffeine? It's a legalized drug. It's one of the few legalized drugs that we can consume on a daily basis. I think it's the addictive nature to it, honestly. There are downsides to it. For example, how much you can consume. So if you think about so that's why the downsides with Celsius is that's 200 milligrams of caffeine. So I mean, you have 2 of them is kind of your limit for the day. Never mind if you're having anything else caffeine, whether you have a coffee or a tea or whatever it may be. Now you can only, you should only consume maybe 1 can. Where something like Coca-Cola back in the day, it was 60 grams of caffeine or whatever. So I mean, you could consume 6 to 8 Coca-Colas a day and still be within the recommended limit. But yeah, no, I think that's why energy is so called the jewel of beverage. It's the fact that it has this caffeine nature, which is extremely addictive.
Perfect. So to get back to the question, why Celsius made its way into your portfolio, any quick thoughts on that? And by the way, because you haven't disclosed it, what's the weight in your portfolio right now? It's more like a direct position, is it?
Yeah, it's about 2.5%, which
Yeah.
if you know me, 2.5% is like, it might as well just chalk it up as a zero. It might as well not even be there. It's really just so I can remember to check in if I look and it's down 15%.
You bought that stake after the recent pullback, right?
Yeah, my cost basis is flat right now, so
yeah,
I think I'm down like 1%.
What made you pull the trigger? Pull the trigger here.
We'll get into valuation, but I mean, it's really the valuation. So to be frank, I've actually been tracking Celsius before. I mean, I've been tracking Celsius since 2018, maybe. I kicking myself in the ass, to be quite frank with you, because before. When I started seeing people really consuming Celsius was probably maybe 2016, 2017. I was being recommended by like friends, oh, you got to try this brand out. But that was kind of before I was into investing. And then when I started investing and really looking at companies, Celsius was probably on the back burner, even though I knew that it was a company. I was worried more about the big caps and stuff. So since I really started finding my niche and what works for me and everything, once again, I've been kind of tracking Celsius, but really it was just always valuation. Since I really started getting into the business and realizing how strong the brand is, it was just disgustingly overvalued in my opinion.
Yeah. So if you want to, we can start talking about valuation, because ultimately I think questions like the international growth opportunity, maybe also management, is tied to valuation as well. So what you can see on screen right now is the free cash flow yield of Celsius over time, and also the EV, so enterprise value to sales multiple. And as you can see, so maybe I was off earlier when I said the stock was trading at, but I think it did actually trade at if we would zoom out further, I think it at one point traded at 40 times sales. But anyway, so obviously the valuation multiple has come down significantly, which is no surprise. The stock is down 70%. But nonetheless, we're still looking at quote unquote only a free cash flow yield of around 3%. So we're still looking at like 33 times free cash flow, which on the surface level would not be a valuation multiple that excites me. Why did you still pull the trigger here?
So first off, before we get into that, I know everyone loves to stress free cash, and obviously free cash flow is really what matters at the end of the day. Free cash flow within the business. Beverage companies, especially when the growth becomes herky-jerky, is focus on the gross profit and gross margins if it's a quality business, right? Like, and you can get a relatively good grasp of the actual breakdown of the cash flow statement over time. But on a year-to-year basis, I kind of throw free cash flow out the window, to be quite frank with you, because tracking the cash flow, so they have to put money out and then they build up inventory. And typically, if it's a stable growing category and it's not interrupted, right? Like you're not going to see any issue. And yes, you can look at the free cash flow and operating cash flow, right? However, net income can kind of smooth that out for you. Gross profit especially is going to smooth that out for you, because once again, it's kind of the inventory buildup and the way that has to get accounted for. So you can see years where you have synthetically high free cash flow yields and synthetically low free cash flow yields. And this doesn't just apply to beverage. This applies to really any company that has to take in inventory and sell it, just in the way that they recognize those revenues. So really for me, I would worry about gross profit. And the reason I like gross margins, gross profit to worry about is because as long as that pretty much tells you that there's really all you need to worry about for beverage companies is the way that how much you're paying to produce the product and how much you're selling it for, right? And that's obviously going to give you, your cost of goods sold, and that's going to give you your gross margin. If there's really ever a real issue with your inventory or whatever, then you have to write off that inventory. That gets put on the books as because your cost of goods sold only gets registered when you recognize that revenue. So even though you paid for inventory, that doesn't get written up as your cost of goods sold. So if I sell $100 worth of goods, then I only register the cost of that $100, right? Now, the only why you want to focus on that gross profit is because if you have to write down that inventory or whatever, then you recognize that as zero sales, but you recognize that as zero sales and all of that cost of goods, which is really going to kill your gross margins. And if that happens and, the gross margins really cut down to maybe 30% or something, then you know that they're having a real demand issue.
Yeah. Nonetheless, and I get what you're saying here. The profit metrics further down the income statement, they fluctuate more than gross profit. That makes a lot of sense to me.
Yeah.
Nonetheless, I think the sort of 33 times multiple I cited earlier, that's based on a free cash flow margin over the last 12 months for Celsius, a free cash flow margin of 16.55%. Let's say, and I just checked, so Monster Beverages over the last 12 months generated a 20% free cash flow margin. And I think historically they have sometimes done a little better. But let's just go with 20%. If we take Celsius revenue over the last 12 months of 1.5 billion, and I'm doing sort of napkin math here, right?
Yeah.
A 20% margin of that would be 300 million. On a 7 billion market cap, that's still a 23 to 24 times multiple, which is cheaper than the one I cited.
Yeah.
But it's not like
so this
crazy cheap, right?
Yeah, no, you're right, and which is why it's still a track position. So this is the way I'm going about valuing Celsius, and quite frankly,
and by the way, so if we are now talking about a low 20s multiple, that's not like super expensive either. So just be clear,
especially for the growth. Yeah. So the way I'm looking at this, right, and this is just the way my brain works, the way I choose to value beverage businesses, right? So first off, we'd have to normalize sales because we can't actually. I see everyone on the internet using their sales figures and then extrapolating that out for growth. We've already discussed that those sales are synthetically high right now, right? Their sales grew 150%, but the demand for the product grew 35% or something. So obviously that's synthetically high. So the real way we could do it, if we really want to get into the nitty gritty, it's not the way I'm doing it for rough, as long as you're directionally right on the business, we can use rough numbers, which I'll get to in just a second. But if you want to be extremely specific on normalizing that revenue, you'd have to go back a few years and you'd have to follow that scanner data. Okay, you'd have to track the scanner data and those depletions, and that would actually get you your proper kind of revenue. However, a more rough estimate, what you could do is you could just take the trailing 12 months revenue, and granted, they are probably going to grow next year. But let's just carry that trailing 12-month revenue to the next 12 months. Let's just say they have 0% growth. And really, let's just assume that the demand is backfilling into that inventory that they've already put out there. Okay. So let's just take that. So let's just assume 50% gross margins on that sales. And let's just, once again, those sales are for 2025. So 50% gross margins. And then that, based on that margin profile, should give us, and this just understanding the comps and kind of what goes into these businesses, that should give us 20 to 25% steady state margins. Okay. So if we assume 20 to 25% steady state margins, that would give us a multiplier to our price to sales ratio of 4 to 5. Okay. So if you're trading at a 1 times price to sales, and it has 25% margins, that's 4 times earnings or 5 times, depending on what. Okay. So in $1.4 billion of sales for the next year on, like you said, a $7 billion market cap, that's going to give us 5 times price to sales next year, which once again is trading right around 5 times this year. We're just going to assume that carries over to next year. So we're talking about forward earnings, right? So 5 times sales at around $30. Okay. This implies a normalized forward price to earnings ratio of 20 to 25 times, depending on, what margins we want to use, whether that's 20 or 25% margins. So like you said, 20, 25 times forward earnings. Is that super cheap right now? Probably not. However,
I mean, whether, sorry, finish your thought.
Oh yeah, no. So the price to sales of 5 times at 30 means that the multiple, right? That multiple that we're paying, the price to earnings ratio, comes down, or that price to sales ratio, I'm sorry, comes down every $6 of share price. Okay. So at $24 a share, we're looking at a 4x sales. And then at $18 a share, we're looking at 3x sales. In other words, at $24 a share, we're looking at a 16 to 20 times forward earnings. And then at $18 a share, we're looking at a 12 to 15 times earnings, right? So that's kind of going to be your sweet spot. So right now, like I said, we're looking 20, 25 times earnings. You'd have to just assume, whatever growth rate you want to use moving forward. But that's why it's just a nibble for me right now. 5x sales, I'm nibbling. 4x sales, I'm really buying. And if it were to ever get down to something like 3x sales, you can start loading the boat. You're buying that at a 12 to 15 times steady state earnings. So
yeah. I mean, ultimately, you have to have an opinion if you want to be a buyer of Celsius stock about the, say, 10-year growth rate the company can achieve on a top line level, but also on a profit metric, right?
Yeah.
And the valuation I did, and before I start sharing the details, the way you could think about it, if you assume the company is trading right now at, say, a 25 times multiple, that would translate into a 4% free cash flow yield. Mm-hmm. If you now believe that 10 years from now, the company will still trade at a 25 times multiple, which is probably reasonable to assume because of the attractiveness of the industry, as you highlighted, it's quite a predictable, somewhat stable industry, and a 25 times multiple for one of the leading players in that space, likely with a larger market cap, a market share 10 years from now, is probably more than justified. Obviously, there are other factors at play here, interest rate environment, and so on and so forth. But I think you don't have to be crazy to assume that in your model. If you can then assume that the company will grow, say, profits at a rate of 10%, you're already looking at a 14% return. 10% plus the
free cash flow
yield
plus
right?
growth. Yeah.
So I don't think you need crazy high growth assumptions for that investment to work out. But how do we get to 10% growth? Can you maybe talk a little bit about, I guess we discussed this to some extent already, the opportunity to continue to grab market share from Monster and Red Bull, but maybe also about the international opportunity. Is the opportunity really that big? You have an opinion on that?
Yeah, certainly. I mean, it's only what 3, 4, 5% of their business right now.
Yeah, it's 5%, and for Monster, it's 40%.
Yeah, so I mean, if you assume even if it gets 25% of their business, right, that's 5 times larger than it is today. And in the U.S., you could argue they're not fully saturated. I mean, I genuinely don't think they are. I would not model out, 35, 50, 100%, even 25% growth moving forward. I think that's crazy. But I mean, if you think, like you said, you want to be extremely conservative. I mean, there's still the demand grew 35% this year alone, right? In the previous quarter, the actual real consumer demand. So, I mean, even if we assume that 15% going forward, I mean, if we assume steady state, right, what multiple would you want to pay for a business growing 15% a year? That's something that someone else would have to figure out themselves. But that's why I'm looking at kind of the waterfall of price points at right around 30, 24, and 18, and trying to weigh it in between there. So
yeah, awesome. So here's my take, and maybe next we can talk about risk, but I will likely not invest at Celsius at the current multiple it is trading at, because as someone not living in the US, which is clearly their core market, I have a hard time truly understanding whether the company will be able to continue to grab market share from the leading players in that space. And I think if I say the company needs to grow 10%, profits at a rate of 10% over the next 10 years, it doesn't sound like much. But if you actually look at the numbers and check how many companies historically that were generating the revenue that Celsius is generating right now were able to compound revenue at 10% over the next 10 years, that number is actually shockingly small. So it doesn't sound like much, but compounding at 10% over 10 years is actually not that easy to accomplish. Talking about risks, what makes you confident that 10 years from now, the brand of Celsius will still be intact? And what I was thinking about before the video was the brand of Rockstar. So again, Rockstar, the energy drink brand, may be perceived differently overseas, but my perception as someone living in Europe would be Rockstar 2 has been a growing brand for a period of time, and actually checked their sales figures for the video, and the sales of Rockstar actually peaked in 2016 and has been in a sort of constant decline. I think Pepsi actually acquired Rockstar not too long ago, and the sales has been trending upward now again. But what makes you certain that Celsius is not going to follow the Rockstar path, so to speak?
So it's kind of a loaded question with the way I kind of want to answer it. But first off, number one, Rockstar, believe it or not, did not promote, did not. I don't think it was a public company, so we probably don't have the numbers. But I don't think they promoted behind with those SG&A margins that we're talking about, 25% of revenue or whatever. I would reckon to bet that they didn't put nearly as much behind it. In fact, in an interview with the with that CEO from like years ago, he pretty much said how he would like to take that money and save it instead of reinvesting in the business. And then, I mean, they also didn't really differentiate themselves if you really think about it. Once again, it was just another sugary energy drink brand. Monster, Red Bull kind of carved out their niches. I think Rockstar just kind of failed to carve out. They were trying to go to like the music scene and stuff, but yeah, I just think they failed to carve out a niche. But then this kind of goes, you asked me how am I confident about Celsius being, relevant and growing 10 years from now. My answer, quite frankly, is I'm not.
Which is reflected in your current position size.
Yes, but really my current position size is actually just valuation more so than anything.
Yeah.
And you and I have talked about this. I look at businesses and investments in different buckets, in different categories, right? If I'm certain, or I feel like I'm extremely certain of that business being around 10, 20, 30 years from now, which very, very far and few in between, I'll pay a slight premium, right? Because at that point, the growth matters more than really the multiple I pay. And I'm not paying a crazy multiple, but I'll pay a fair price. With something like a Celsius, where I at least have boots on the ground, I can see consumer behavior before it's going to show up in the actual financial data, right? Once again, going back to that scuttlebutt approach, I'm comfortable at that point investing in a business that I think at least 3 years out is going to continue to grow. Probably have a hunch 5 years out it's going to continue to grow. At that point, it gets a bit foggy after that, but I don't need it to grow necessarily after that, as long as I can, I have boots on the ground and I don't have to wait for a financial report to come out before I have a hunch of, ooh, this company's hitting trouble. If I go into every single grocery store and I can see that all the other energy drinks are selling and Celsius is still sitting there, okay, there's some red flags I need to pay attention to. But yeah, I don't think I am confident 10 years out it's going to continue to grow, but I am 3 to 5 years out. I think it will continue to grow. And at that point, I just want to buy it at a multiple that reflects that. So,
yeah. And I guess it's reasonable to assume that, say, 5 years out, the company will actually grow at a rate higher than 10%. If we just look at analyst projections, I think they are modeling. Okay, I prepared it actually. Let's have a look. I think for the next calendar year, where is it, 2025, they actually project 19% revenue growth. And then they actually assume that in 2026, that revenue growth will actually accelerate to, 21%. And net income is actually going to grow at an even higher rate according to these projections, just because they assume the margin profile is going to improve. So yeah, I love the clarity, Andrew, you have with regard to where you or how you categorize some of your investments and how that would then translate into different position sizing. So correct me if I'm wrong, but what I'm hearing here as well is that Celsius is probably one of the faster growing companies in your portfolio, but the outlook is also a little more opaque, so to speak, which is why this would never be a 20% position in your portfolio unless it's trading at an absurdly cheap price. Would that be a fair way to put it?
Yeah. Yeah. Yeah, I guess because right. So if we take my top three positions, right, Meta, Boston Beer, and Interactive Brokers, those are all companies I'm looking 10, 15, 20 years. Um, yeah, after that, it definitely drops off with time frame. PayPal too. But
Mhm.
a little bit not as strong. But yeah, definitely. For example, something like PayPal was extremely cheap. And I think at one point I got that up to 20% on cost. Probably wouldn't go more than that, but yeah, I mean, if it were extremely attractive, I would bet big on it, assuming that 3 to 5 years out. But I weigh it in a sense where okay, let's say I bet 20% on it. Probably of that 20%, maybe 5, 10%, so maybe half of that position would actually be a valuation play that I'm actually
Mhm.
looking to sell once I believe it gets to fair value. Then I'll trim my position in half. Then the other half of that position, maybe 10% of my portfolio, that would be a bet on the long-term growth. And then at that point, I would just watch it and kind of watch consumer behavior and make sure what I'm seeing matches up with the financials and everything. But yeah, I definitely put everything in buckets when I invest. So yeah, you're probably right, but I could definitely get it up to 20, 25% of my portfolio, but it wouldn't be a buy and hold forever 25%. It would be, half of that would probably be a valuation play if it got cheap enough. So
Awesome. Before we wrap it up, I have one more thought here, and I'm just going to think out loud here. If we look at the next quarter of Celsius, chances are that the numbers are going to be rather disappointing again. I just want to include one more quote from the Piper Sandler conference here. So again, the executive, and I think he's the chief of staff, if I remember correctly. He said, so short term, like Q3, and I think that's Celsius next quarter, there's going to be a lot of noise because when you have a certain anticipation on revenue coming in, you base your entire margin structure of what your budget is, and all of a sudden, your largest customer purchases about 120 million less than you would anticipate, and that's Pepsi, right?
yeah.
Yeah. It's going to create some noise in the short term. But it's the short term, like Q4, maybe a little bit of noise there, but it should be gone. And we should be back to our framework that people have seen. Last quarter, Q2, I think we came in around 2050. Anyway, that doesn't really matter. So the point I want to make here is, and obviously we don't know what's priced in by the market. And I don't have an opinion on how the stock is going to react to maybe disappointing Q3 numbers. But I definitely have Celsius on my watch list now. And as we sort of discussed, if the price continues to come down, let's say we see another 20% drop, I might actually get interested in that stock because then I think we are looking at a more attractive valuation that requires lower growth assumptions over the medium and long term, right?
Mm-hmm. Yeah. Once again, I mean, yeah, you're probably right. I think your math works out to that being about 4 times sales. And once again, 4 times sales, you're looking at, depending on where you want to put that margin, probably 16, 18, at the most 20 times earnings, but probably mid to high teens. Then it
Yeah.
gets extremely attractive. Yeah.
Would you be ready to trim another position to allocate more to Celsius once we get to a price range, say below $24 a share?
Yeah. Yeah. I mean, you're constantly, if you're working with a portfolio, and me, I don't have that many companies, so I'm constantly trying to weigh opportunity cost. But yeah, I'd probably, there's already one I've been trimming, so I mean, I'd probably just continue to trim that one, but
Okay.
I'd probably just sell it out entirely. So
Yeah. Any closing thoughts? I think we covered most of the stock. I think we should wrap it up. We didn't spend too much time talking about management, but I think that probably deserves
yeah.
it's a separate
Yeah,
video.
I apologize to the audience. I ramble a lot. That's why I always
Oh,
need I need a script if I'm just talking off the cuff. My mind wanders, but
but that's
I
the
hope
whole point
they
of
got
this
value.
format, right?
Yeah,
Just two dudes sharing sort of
two
spontaneously
dudes.
their thoughts on various investing topics.
Yeah, I hope they're able to take something away from it anyway. So,
All right, Andrew, thank you very much, and we'll talk in 2 weeks.
all right, sounds good.